The truth about investing in startups is a topic that often gets overshadowed by the success stories of companies like Facebook, Google, and Amazon. While these examples highlight the potential for massive returns, they also create a misleading perception about the reality of startup investing. Most startups fail, and the path to success is rarely straightforward or quick. Investing in startups involves putting capital into early-stage companies that are still developing their business models, products, and markets. These ventures are typically high risk because they lack a proven track record and may not generate revenue for years. Investors must be prepared for the possibility of losing their entire investment, which is why it's important to approach this type of investing with caution and a clear understanding of the risks involved. One of the main reasons people invest in startups is the potential for significant financial returns. If a startup grows rapidly and achieves a successful exit through acquisition or an initial public offering, investors can see returns that far exceed those of traditional investments. However, such outcomes are rare. Studies show that only a small percentage of startups reach a stage where they can provide substantial returns to investors. Another important factor is the time commitment required. Unlike stocks or mutual funds, which can be bought and sold relatively easily, startup investments are illiquid. This means that once you invest, you may not be able to access your money for several years. Investors need to have a long-term perspective and be willing to hold on to their shares until the company reaches a certain level of maturity or exits. Diversification is key when investing in startups. Putting all your money into a single venture is extremely risky. Instead, investors should spread their capital across multiple startups in different industries and stages of development. This helps reduce the impact of any single failure on the overall portfolio. It's also essential to understand the role of the startup team. The success of a company often depends heavily on the skills, experience, and dedication of its founders and employees. A strong team with a clear vision and the ability to execute can significantly increase the chances of success. In addition to financial returns, some investors choose to support startups for other reasons, such as social impact, innovation, or personal interest in the industry. These motivations can influence investment decisions and should be considered alongside financial goals. Finally, it's important to seek professional advice before making any investment. Financial advisors, angel investor groups, and venture capital firms can provide valuable insights and help assess the viability of a startup opportunity. Due diligence is crucial, and investors should thoroughly research the market, competition, and financial health of any startup they consider investing in. In summary, while investing in startups can offer the potential for high rewards, it also comes with significant risks. It requires careful planning, a long-term mindset, and a willingness to accept uncertainty. Understanding the realities of startup investing can help individuals make more informed decisions and avoid common pitfalls.